The only currency that really matters in the UK macro right now is credibility.
I'm confident that the UK will come through this. I can also see that over time the pound is coming back.
I think it's hard not to draw the conclusion that all this will require a significant monetary policy response.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Tough week. The pound eyes parity and gilts take a battering as the Chancellor vows to push on with tax cuts. Time to reevaluate. The IMF actually slams Truss's government's tax cut plan as the BOE chief economist. Hugh Pill says it will require a major policy response. And this hour we discuss the Bank of England and the UK economy with Mohamed el-Erian from Allianz and finance with the UK chief executive of JPMorgan's consumer bank, Chase. So we'll have, of course, two great exclusives that we want to bring to you. But first, let's check on the markets. Of course, a lot of the focus is on the FTSE, but actually, in the last half an hour or so, a lot of the focus is on the 10-year Treasury yield, rising above 4%. That's the highest since 2008. Now, the picture here is part of a global context, of course, of dollar strength, with the White House saying there cannot be, or they don't want necessarily an international agreement, and so that's putting a lot of pressure on other, of course, currencies here, also specifically stuff that's going on in the UK. Now, the International Monetary Fund has delivered a stinging rebuke of the UK's new unfunded tax cuts, calling them excessive and in need of revision. Now, also speaking exclusively to Bloomberg, Deutsche Bank Chief Executive Christian Saving addressed the turmoil in UK markets. He says he would not go as far as calling it a currency crisis.
I'm confident that the UK will come through this. I cannot tell you actually what the today's rates move are, and volatility, as I said, stays. But I can also see that over time the pound is coming back.
Let's bring in Bloomberg's Simon White with the very latest. Simon, what is going on? I mean, usually tight-lipped, also IMF is now weighing in. What's happening in market sentiment?
Well, we're seeing a little bit of, obviously, a recovery in the short term. But, I mean, your previous segment said it's not a crisis. I mean, I think it's very hit and miss.
Nothing to see.
Nothing
here.
to see here. I mean, it's well, sterling crises are pretty frequent. If you look post-war, they happen on average every 15 years. You know, you had 1947 devaluation, 1967 devaluation, the 76 IMF bailout, the RM crisis. So, unfortunately, they're not uncommon.
Okay, but they're not uncommon, but how ugly does it be? So if you look at, I'm not exactly sure what we're living through in the UK, right? Because a lot of people are saying, well, this is overdone, it was radical, but it wasn't the end of the world. You have the IMF now weighing in. You also have this dollar dynamic where we're seeing, you know, the dollar ever rising, the White House saying we're not going to do anything about it, and US 10-year Treasury is at 4%. Yeah,
I mean, it's quite a cocktail of things happening. I mean, the UK is kind of, as always, it finds itself in the centre of the storm. You're right, the Fed is not going to do anything. They are pretty clear that they want to get inflation down and core inflation, and they're not really going to do anything about changing their policy until they get that done. The rest of the world will have to kind of suck it up in the meantime.
Suck it up how? Is there, if you're an investor right now, where do you look at? So are people panicking, or are they just trying to ride the wave?
Well, I think right now, I mean, you're not looking for opportunities, right? You're trying to salvage, capital. It's about the whole return of capital rather than return on capital right now. I mean, people need to see things settling down. Liquidity is very low in the markets. So this is really a time to sort of stand back and reflect and wait for things to calm down.
Simon, I mean, the other thing that we're, again, trying to figure out as we look at Britain and the balance, so we're going to see very aggressive moves from the Bank of England. Could we reach like 4% very quickly? I mean, I think the market is pricing in 200 basis point hike. And then there's a huge implication for savers because of where gilts are doing. Or is it the government that will have to do a U-turn?
It's, you know what, the way it looks right now, we need to get fiscal credibility back. So the Bank of England is kind of boxed in. In fact, they might actually make the situation worse by tightening policy, which is all they can really do. So it's going to need to be both parties are going to need to do something. The government certainly is going to need to do something to try and regain some fiscal credibility, because without that, it's very difficult to see how this situation gets better before it gets any worse.
Simon, thank you so much. Bloomberg MLive's Simon White there with the very latest on some of these market moves. Now, also joining us is the Allianz Chief Economic Adviser, also Bloomberg columnist Mohamed el-Erian. Mohamed, I've been dying to ask you what the prescription is for the UK. I mean, given all of the uncertainty, given what the UK markets have done and reacted to, What will happen in the next 3 weeks? And good morning.
Good morning. I'm not sure what will happen in the next 3 weeks, but if you're trying to stabilize the situation, what should happen is three things. One, the government revisiting the large unfunded tax cuts and postponing them. Two, the Bank of England hiking interest rates. And three, the government providing more information on the growth impact of its measures. If they do that, they can stabilize the situation and reverse some of the price moves that are going to have a huge impact on economic prospects and inequality.
Mohamed, what is most vulnerable in this kind of economy? So what happens to UK housing? What happens to mortgages? What happens to savings?
So think of UK households and UK businesses being hit by four things at the same time. One is higher borrowing cost, and you've seen what's happening in the mortgage market. It's no longer just about the price of a mortgage, it's about the availability of a mortgage. The second is a wealth effect, a negative wealth effect. You talked about what's happening to pensioners earlier. You showed this very stunning graph. Third is an income effect, because people are now worried that we're going to go into a deeper recession. And then fourth is the inflation effect. You cited earlier what's happening to prices in supermarkets. So it is hard to hit a population, both household and businesses, with these four things at the same time and not expect major damage. That's why the government has time now to try and get the situation back under control.
Yeah. But Mohamed, do you think this is incompetence, or is this just trying to take a big gamble, trying to be radical so that the economy will be in a better footing in 2024? Is this all because of the election cycle?
I think it is a big gamble. Look, two of the three elements of the package were sound. The structural reforms promoting growth and productivity, that's sound. The stabilization of energy prices, that's sound. It is the third element that undermined the first two and are now counterproductive to the government's objective. So I think there's an issue of design, there's an issue of sequencing, and then timing. All this was introduced at a time when global markets were already nervous, and there was already generalized pressure on yields and on currency because of the relentless increase in the dollar. And this just was an additional fuel on a fire that was already burning.
Mohamed, when you look at some of the investors, I mean, they say, look, at least the UK has fiscal authority. It has much more independence because of the Bank of England. I know we could go through a lot of pain, but how do you find a weakness, or how do you find bottom for sterling? How do you know when it's time, if at all, to come back into gilt?
So first and foremost, it's important to stress this is not 1976. This is not a situation in which the UK is going to go cup in hand to the IMF for emergency loans. This is not a situation where you get a massive balance of payments crisis and a massive sterling crisis. But it is a difficult economic situation. When do you go back in? If you're looking at the long end of sterling, you go back in when it's very clear that the growth effect is going to overwhelm the inflation effect. And that's going to happen, unfortunately. If you're looking at the short end, you've got to make a judgment on the Bank of England. I think the Bank of England will hike and will have to hike aggressively. I favored, and I still favor, an intra-meeting move, but I understand why they're cautious and want to wait till November 3rd.
So how aggressive do you think they need to be, Mohamed? At the same time, I think the Bank of England is starting QT on Monday. That's a pretty spicy mix.
Yes, it is, and it's all over the world. And let's not forget the Fed in particular, which is a price maker for many, many, many economies around the world. And they are late, and they are falling into the second part of a big policy mistake that will go down in the history books. The Bank of England is going to have to be more aggressive than it would have a week ago. I think a week ago, most people thought the next one would be 50, 75. The next one will have to be at least 100 basis points.
Mohamed, I'm looking at treasuries, okay? U.S. treasuries, that yield rising above 4%, the highest since 2008. I mean, if you just look at the trajectory of where they are now and where they need to be, is it inevitable that treasuries go at 5%?
It's not inevitable because you have two paradigm shifts clashing. One is a change in financial conditions. We are coming out from this period of highly distorted financial conditions where interest rates were suppressed, where we have predictable and massive injections of liquidity. All that is gone. Inflation means that you cannot conduct that sort of monetary policy anymore. So we have a fundamental change in the liquidity regime and in financial conditions. That suggests that yields have further to go. However, we also have a fundamental change in the growth regime. Unfortunately, we've entered a period where growth is going to be challenged, where a global recession is a high risk. So you've got these two effects interacting. And then adding to all that is a loss of credibility in the Federal Reserve. So it is very hard to predict with a high degree of accuracy and confidence where yields are going to be in 6 months' time.
How long do you think this ongoing global bond market rout will continue?
For a while. You know, Francine, ask yourself, what haven't we heard? If I had told you we would get 100 to 150 basis point moves in a few days, you and I, because we've been around for a while, me much longer than you, of course, but because we've been around for a while, we would ask, okay, where's the pain trade? Who's really hurting? Who's on the ropes? We haven't had yet indication of stress. Now, that's good, but I worry that that's still ahead of us. So don't underestimate the technicals that are in play here. But overall, I think we're coming to the last phase of both dollar strength and this surge in yields.
So you think we've reached, I mean, is there a level actually to which, and we heard from the White House, they don't really want to work on some kind of global accord to temper dollar. Do you think we're seeing almost the end of dollar strength? Because at the moment, it doesn't really look like we have a ceiling for it.
Correct. So remember, the dollar had three very strong tailwinds. And that's why I've been warning for a couple of years ago now, don't fade the dollar, don't fade the dollar. One is interest rate differential. Two is growth differential, and three is safe haven differential. And all three have been powering the dollar to record levels. Interest rate differential advantage is starting to diminish. The growth advantage will at some point start diminishing because the US faces a much higher risk of recession because of the Fed. So it's going to be just a safe haven. Now there's a limit to the safe haven. Look, it wouldn't surprise me if the dollar strengthened. I do have a target in the back of my head. I'm not going to tell you what it is. We're not there yet. But we are, you know, it is interesting that we haven't heard the U.S. complain about competitiveness. Something that hasn't been covered today, look at the Chinese currency. Last I looked, we were at 723. You put that graph up, it goes straight up in terms of weakening. In the old days, the US government would be complaining about currency wars, about what that does to competitiveness. But because inflation is the main concern today, the government in the US actually welcomes the appreciation of the dollar because it reduces imported inflation.
Mohamed, you're killing me. How can you not give me a target for dollar if you have it? Like, but we'll have to talk online. Is this a perfect storm? So for the last 5 years, we've been talking about storms, perfect storms, but it feels like the market isn't fully aware of it, but this is what we could see soon.
Yeah, although it's improving, the market still has a cyclical mindset. It still thinks that we mean reverting to an old world. We're not. We're going through a major paradigm shift. It has multiple components. It is, in my view, a very bumpy journey to a better destination. So once we get to the destination of less distorted finance, of better allocation of capital, of better risk-taking, we are going to be in a better place overall. And we're going to emerge from this period of incredible distortions. However, it is a very bumpy journey. And I think the mindset in the marketplace is still mean reverting, thinking we're going back. We're not going back. This is a secular shift and one that we're going to have to navigate and hopefully get through it because the destination is a good one.
Mohamed, thank you so much. The Allianz Chief Economic Adviser, of course, our very own Bloomberg columnist, and I will have to hound Mohamed for that dollar call. He is Mohamed el-Erian. Coming up, we continue the conversation with the UK Chief Executive of JPMorgan's digital bank. That's Chase. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now, at a time when the UK economy is under severe pressure, Wall Street titan JPMorgan is continuing its expensive push into the country's retail banking sector. Chase now has 1 million UK customers since its launch 12 months ago. That's already surpassed Goldman's digital rival Marcus, which launched in 2018. Both are still a long way behind traditional consumer players like HSBC. Well, I couldn't be more happy than to have Sanjeev Somani there, JPMorgan's UK Chief Executive for Chase and Nutmeg, on air with me. Sanjeev, thank you so much for coming on. First of all, you've made it to the 1 year, so congratulations on that. What can you tell us a little bit about your customer base? How's it going? Who will sign up? And what are some of the perks that you need to do going forward?
Sure. So we have been extremely pleased with our performance. In the first year, you covered some of it. We have over 1 million customers. We have more than 10 billion in deposits from these customers. Yeah. And the customers, we have been very pleased with the spread of our customers. They come from all over the country. We even have a 90-year-old plus customer. So we are appealing to all segments of the population, which is great.
How do you now make it profitable? So I don't know whether this is a third or fourth, card that they have. And I know you've offered some perks, some of the cash back and things like that. Is it difficult to then turn it into a profitable business where it's the main bank account?
Yeah, I think the perks are to help the customers try out the product initially. But our hope is once they try the product, they like it and they stick with us. And we also have a plan for additional products and services, which as the customers love the product and it meets their need, they'll try new products, and that gives us the whole relationship over time.
Sanjeev, I remember actually maybe 6 months before you were launching this, speaking also to one of your executives, and they were saying, look, we're also trying this out to see if it works in the UK market, and then we roll it elsewhere. Given all the trial and tribulations and the fact that inflation is higher than other countries, that of course, the pound currently is all over the place, is it still a good place to try it out before you could potentially roll it out in Europe?
Yeah, I mean, you have to look, for businesses like these, you have to look across a 10-year period. And in that 10-year period, you have to look through the economic cycles and look at the long-term vision for these businesses. And we feel retail banking is a very attractive pool outside the US. It's over $1 trillion. And we'll start with the UK and cautiously expand in other countries.
So you don't think that this cost of living crisis, and again, the frankly crazy market moves that we saw in the last couple of days, somehow will be difficult to manage for Chase?
In a way, we built the whole business during COVID, and we were already planned for these scenarios. So the product we have offering actually helps customers during the cost of living crisis. So we offer 1% cash back for 12 months. So this is, a customer anyway spending £1,000 a month gets back 120 over the year. We offer lots of money management tool in our app, 24/7 customer service if a customer needs help anytime through the app. So all of those features.
You sound like an ad.
I'm an evangelist for my product. That's the only one I use right now.
Sanjeev, I mean, the concern, I guess, is that it costs money, right? So this is about market share, but I think JPMorgan said you'll lose about 5 billion, if I'm not 1 billion in overseas digital banks. So this is not only for the UK to make sure that you reach the right market share. So again, is this important to just be seen, get the market share, even if you lose money, because then people will stick with you longer term?
Yeah, so we announced at Investor Day that we'll be investing about 450 million this year, and then in about 4 to 5 years we break even, and the plans haven't changed. The investment is actually on 3 things. First is building a greenfield digital platform, which I think is a huge assets that can be used for the broader firm, not just our business. Second is customer, so marketing, and as well as all the operations around it. And finally, sharing some of the value with the customers to try our product and ultimately make us the primary bank.
I mean, look, pound is cheap. Why not do some M&A here?
For the right opportunities, we'll look at them.
For what kind of, I mean, is there a particular segment actually that you'd be interested in getting into?
Our medium-term objective is to be a full-service retail bank in every country we operate in, to meet all of the customers' needs. And we are building organically, and as and when there are opportunities in specific areas to complete our product or have a particular customer segment, we'll consider them.
I know you said you have a 10-year horizon, but how much do you worry about, the savings really being drawn out because of volatility and gilts and some of the concerning, the cost of living crisis will hurt, of course, how much people save. Do you worry about mortgages and then people not being able to repay?
We do not offer credit at the moment, though that's our plan in the medium term, so that should help. Right now, the product we have actually helps the customers because we have a current account, we have a linked savings account, whereby in these uncertain times for customers, we have no restrictions. Customers can withdraw money as and when they want, and it's a competitive rate of interest. So together, the package actually helps customers during the cost of living. We do not charge any fees as well.
Sanjeev, thank you so much for joining us. Sanjeev Samani there, JPMorgan's UK CEO for Chase and Nutmeg. There you go. I was so excited talking about new entrants in digital that I've lost my voice. Let's now get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Russia's energy conflict with Europe has escalated dramatically as 3 natural gas pipelines were wrecked in what European authorities are calling an act of sabotage. Gas prices are higher this morning. This as Gazprom also warned the last remaining gas route to Western Europe is at risk of closure. Now, the IMF has delivered a stinging rebuke of the UK's new unfunded tax cuts by calling them excessive and in need of revision. The International Monetary Fund said given elevated inflation, it is important that fiscal policy does not work at cross purposes to monetary policy. Speaking at the Labour Party annual conference, opposition leader Keir Starmer added to criticism of those measures.
They've crashed the pound. And for what? Higher interest rates, higher inflation, higher borrowing. And for what? Not for you, not for working people, for tax cuts for the richest 1% in our society.
Now, Russian leaders have declared victory in a series of stage-managed, UN-condemned referendums as the Kremlin moves to annex a large chunk of occupied Ukraine. The head of the self-styled Donetsk People's Republic posted on Telegram that 99.23% of those polled had voted to join the Russian Federation. A state-owned news agency also reported landslides in 3 other regions that also held those votes yesterday. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. We're seeing actually huge moves when it comes to fixed income. Right now, the UK 30-year yield rising to the highest since 1998. Now, this is ahead of a debt sale. Remember, yesterday was quite a big deal because it actually surged above 5% for the first time since 2002. Investors seem to be bracing for a flood of bond supply and aggressive rate hikes. The sell-off that we've seen really has wiped out billions in bondholder values and leaves investors demanding more yield to hold the nation's debt than Greece. So just think about that, UK versus Greece. Coming up, navigating Italy's new political era, we're joined by Rodolfo De Benedetti, chairman of Italian conglomerate Cheer. This is Bloomberg. Here are your top stories. Bleak Wednesday. Stocks and bonds slump as the dollar pummels the currencies from the euro to the yuan. Time to reevaluate. The IMF slams the Truss government's tax cut plan as the BOE chief economist Hugh Pill says it will require a major policy response. Plus, Russia declares victory in sham referendums in occupied Ukraine. Europe calls damage to Nord Stream sabotage, with Poland pointing the finger at Moscow. Well, good morning, everyone. There's certainly no shortage of news. Welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So Italian firms are navigating a new political climate following the election of Giorgia Meloni, the country's most right-wing leader since the Second World War. CIR is one of those companies, a giant conglomerate. It owns Sogefi, which makes automobile parts for Ford, Fiat, and Renault Nissan. And Cost Group is also part of CIR. It provides healthcare services in Italy, Germany, and India. Well, Rodolfo De Benedetti is chairman of CIR Group and partner at the investment management firm Decalia. So thank you so much for joining us. Rodolfo, I have like a million questions. First of all, about Italian business, but also COVID, supply chains. And then I want to talk to you a little bit about Decalia. When you look at the markets, is this, almost a perfect storm? Do you worry that we're going to see many more losses?
Yeah, I think it's a very difficult time globally. I think we're witnessing the end of a very long cycle of very low inflation or non-existent inflation, very low or negative interest rates, very stimulating monetary policy, and very lax fiscal policy. I think we are getting to the end of this, and this needs a period of adjustments in the markets, which has been pretty brutal in the last 6 months.
So how much more of an adjustment will we get? I mean, we're looking at, the UK 30-year, I'm looking at US Treasury, we're looking at stocks. Like, is this just the beginning of this readjustment? Or
it's always dangerous to make predictions, and I won't try to venture in that exercise. I'm not too optimistic short term. I think, the volatility will probably be with us for a while. In my opinion, the adjustment is not over yet. And I think, the geopolitics and the crisis in Europe is creating a deep pressure on the economy. And, I believe we are probably in a recession already. If not, we're going to be soon.
First of all, what does that mean? Are companies going to go bust? So are there opportunities actually for investors to try and pick, some of the assets?
Yeah, I think the timing is important because, as you say, catching a falling knife is a dangerous game. I think, the change in the regime in terms of the monetary policy and the interest rate environment is going to expose the weakest players and the weakest business models that were basically promoted and created counting on that very easy money and cheap money. And if that is gone for a while, at least, I think that will expose weaknesses in the system. And so, yes, I think that, probably over the next couple of years, we will see companies going out of business and countries becoming under pressure. I think we've grown with the idea that Western Europe, we had sovereigns that were high investment grade countries.
Yes.
And I think that's not a given because we're exploding public deficits and debts pretty much everywhere, and this is, I think, very challenging.
So what does it mean? I mean, even 5 months ago, we're still talking about TINA, right? There's no alternative. So that if you had money, you had to put it to work in these, I guess, old school markets. Where does that money flow into today?
I think there are a lot of alternatives today. Today you have risk-free alternatives at 4 to 5% in US dollars and probably not far from 3 to 4% in euros short term. So I think TINA is gone.
Gone? I mean, forever? Is the money that then
forever?
Comes back?
Forever. It's always a mistake to say things forever. But I think the determination with which central banks over the world are fighting inflation and are talking about significant increases to come in interest rates, I think will make this a fairly medium to long-term game in terms of the cycle.
Rodolfo, I want to talk also a little bit about CIR. So you have automotive and healthcare.
Yes.
I mean, how has supply chains variation because of COVID, but also the trade war and the place not only in Ukraine but also the place between the U.S. and China changed everything?
I think you used the expression "perfect storm." I think that's a good description. In the auto business, everything went wrong in the last 2 years. We're experiencing sales and production volumes that we have never seen in the last 45 years. And I think companies are adjusting to that by slashing cost, by becoming more efficient, and by being disciplined in prices. Because when you have your input costs that rise as much as they have in the last 2 years, you have to be very disciplined not to go out of business. And I think the strongest players will manage to do that. But I think there will be selection and there will be consolidation in that business.
So how many, and this is something that, a theme I guess that we've been talking for a long time, is that if you look at the number of automakers out there, it especially as we transition to EVs, maybe doesn't make much sense. How many will there be left in Europe?
Yeah, you're right. I think we've been talking about consolidation for a long time. I'm not sure that I see that a lot in the OEM space. It's probably going to happen more in the supplier space. I think lower volumes and the transition to EV will force that, both because of efficiencies and cost, but also because of technology and presence in certain markets that are will be driving the growth in the next few years. But you're right. I mean, it takes time.
Rodolfo, we just also came back, of course, from Rome, where we had Giorgia Meloni as Prime Minister of Italy. The jury is frankly out on what it means for Italian businesses, for also, well, for the right wing in Europe. What do you think she'll bring for the Italian economy?
Well, I don't think I'm taking a big risk in saying that we have witnessed the worst political campaign that I've ever seen since I'm an adult. In terms of the lack of serious discussions about the real issues that are facing the country. I haven't voted for Giorgia Meloni, and I don't share her political ideas. But we're in a democracy. The voters have voted. There is, on paper, a right-wing majority, and I just hope that they will quickly form a government. I hope that this government will be made up of competent people, and I hope that by stopping to campaign and to make outlandish promises that will never be enacted in reality, but by focusing on the issues, I hope that the new government will be able to govern. Yep. And will be able to continue along the lines of the previous government, which means pro-European, the international alliances that Italy has been part for the last 50 years, without fantasies that sometimes we hear about.
Rodolfo, thank you so much, as always, for coming on. Rodolfo De Benedetti, their chairman of Cheer Group. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Saudi Arabia's 86-year-old king has appointed his son, Crown Prince Mohammed bin Salman, to replace him as Prime Minister. The appointment formalizes MBS as the leader of the kingdom's government. President Mohammed already oversees major portfolios, including oil, defense, economic policy, and internal security. Now, Apple is said to be backing off plans to increase production of its new iPhones this year after an anticipated surge in demand actually failed to materialize. Sources say suppliers have been told to hold off ramping up iPhone 14 output by up to 6 million units in the second half. We're told Apple is now aiming to produce 90 million handsets in the period, roughly the same as last year. And Phil Mickelson and other top golf players are withdrawing from an antitrust lawsuit against the PGA Tour over their suspension for taking part in Saudi Arabia's rival Live Golf events. Mickelson had previously said that he was considering withdrawing from the case because Live is now suing the PGA itself. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Coming up, we go live to the Bloomberg Technology Summit here in London, where we'll speak to the Farfetch Chief Executive and Founder, José Neves. That's coming up next, and this is Bloomberg.
The pain process that's about to unfold is just begun.
I think the market clearly
understands what's happening.
Right now, credibility is the key.
We're probably getting closer to a bottom.
You've got to stay defensive at this point.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The dollar soars to another record. President Biden's top economic advisor says he doesn't see another Plaza Accord-style agreement to weaken the greenback. Apple's putting plans to boost production of its new iPhones on hold. The expected surge in demand didn't take place. And Deutsche Bank's CEO predicts a deeper recession in Europe over the next year. Christian Saving sits down with Bloomberg TV for an exclusive interview. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And it is certainly risk-off here in Europe, Kailey. Higher yields, higher dollar, and we're back to that cycle.
Yep, yields up, dollar up, and stocks broadly down. That was definitely true in Asia overnight. The MSCI Asia Pacific Index as a whole falling the better part of 2%, which brings its total drawdown from its last peak to 36%. That is an even bigger decline than we saw during the height of the pandemic panic in 2020. It is actually the biggest drawdown we've seen since 2011, so absolutely brutal for these stocks, and it's really tech specifically that is creating a drag. The Hang Seng Tech Index overnight down about 4%. Now, part of that just has to do with the higher rate story around the world, but part of that also has to do with the Apple scoop that Anna was mentioning, the idea that demand just isn't there, therefore it is abandoning its plan to boost iPhone production beyond 90 million units, which is the same number as last year. So that weighed heavily on some Apple suppliers in Asia, including LG Innotek, which was down about 10.5% in South Korea. And then coming back to the dollar story and foreign exchange, the dollar is stronger against basically everything today, including the Chinese yuan. The onshore yuan at its weakest level since the financial crisis. The offshore yuan now at its weakest level on record, going all the way back to when that began in 2010. Right now, it is approaching 726 against the U.S. dollar. Matt, these numbers are absolutely remarkable.
Yeah, big moves, to say the least. And of course, the Apple story has a lot to do with the equity malaise that we're seeing. Yesterday, there was a turnaround in the market to the downside throughout the session. Now we see that futures are down about 0.2%. We closed yesterday, I think, at 36.47. So we're so far from the year-on-end target that strategists have, the median being, I think, 4,300, that you should see some revisions downward in the next couple of days, if not today. The Bloomberg U.S. Dollar Index, really an even bigger cause for concern than the drop in Apple. Of course, Apple is so heavily weighted that it makes a huge difference in the S&P, but the dollar index is hurting everything. 1359, the level here. As this rises, of course, it crushes currencies worldwide and causes other central banks to need to raise rates even further. So that's a problem for the global economy. The 10-year yield up to 4%. Right now we're at 398.63, but we've been up over 4%. This is a pretty astounding jump. Treasuries have fallen, I think, 33% so far this year. Much worse than the global ag, which is down just about 23 or 24%. By the way, the S&P 500 is down 23 or 24% this year to date as well. And then Bitcoin, just another risk-off indicator. It's normally very well correlated. The last couple of days we've seen a little bit of a reversion of that, but now it's back to showing what stocks are showing, off to $18,733. Anna, what do you see in terms of the European markets?
Yeah, we see a lot of red on this screen, Matt, to answer briefly your question. So a lot of negativity for European stocks, and the detail sector by sector doesn't tell a positive picture. Healthcare, the only sector showing any brightness in the earlier part of the trading session. The banking sector, the worst performing sector. So even a sector that could benefit from higher interest rates, behaving badly, being the worst performer here in Europe as a result of concerns about the European economy, and those seem to dominate. Let's have a look at what is driving some of the most recent fear. And once again, we're back to talking about higher gas prices. The gas benchmark back over 200 euros per megawatt hour. We've seen what the European Union is now calling sabotage of Nord Stream 1 and Nord Stream 2. And even though they weren't delivering gas, that's still a bad sign for winter, of course. And now questions being raised over the pipeline that goes through Ukraine, the last remaining one from Russia into Western Europe, and what happens to that particular pipeline. The euro is down by 0.4%, now has a 0.95 handle, a 20-year low for the single currency. We're also watching what's happening with the fortune news of European corporates. We'll ask our guests about this a little bit later on. The cost of insuring against default on European corporate debt has now increased to the highest since 2012. And we are seeing that spread widening story happening here in Europe, even if it's not a global one just yet. In terms of yields going higher, this is the 30-year bond yield. This has gone over 5% now. This started September with a 3 handle. It was 3.1 at the start of this month. That is how far we have traveled in just less than a month. Substantial moves higher. Highest yield on this particular debt product since 1998. Again, the cost of corporate borrowing very much in focus. And ST Micro, I put this one in here, Matt, because it was a read across from the Apple story we mentioned in our headlines, down by 5.6%. There is some weakness in some areas of tech as that sector once again takes note of the Apple news flow and also the higher rate environment.
Yeah, of course, it's a big heavyweight and a very hard hitter, but not quite as big as King Dollar, soaring to yet another record after the White House talked down the prospect of a currency agreement to weaken the greenback. White House National Economic Council Director Brian Deese spoke on the David Rubenstein Show peer-to-peer conversations yesterday.
Do you see any possibility of a global accord to kind of adjust currency values the way there was with the Plaza Accord, or is that just not something you're focused on?
I don't anticipate that's where we're headed.
Bloomberg's Danny Berger joins us now for more because this obviously has had ripple effects across markets globally, Danny.
Yeah, I mean, look, dollar did perk up after we heard from Brian Deese saying that. But I got to say, Matt, I mean, it's not necessarily just the lack of Plaza Accord. I don't think many people really expected that. After all, a strong dollar, it benefits the U.S. They need it right now to help keep inflation down. But it leads to this vicious feedback loop where continued strength of the dollar means other central banks need to hike, as you pointed out, Matt. So you get yields rising, people sell risk. And what do you buy? The only thing that works is the dollar. Really strong dollar today and in past days is just a symptom of this, that it's the only thing that works in this market at a time where you had Fed speakers continuing to talk about the need to be hawkish, that credibility is at stake, and of course the continuing energy crisis in Europe. All of that just continues to feed into a dollar, which we've talked about peaking. It hasn't really. And treasuries also reflecting that risk off that concern of the current environment. But what is interesting, what's different about this treasury sell-off today and yesterday that we have seen is it's the long end of the curve here. Yes, we've had really bad auctions, a 5-year and a 2-year so far this week that led to a sell-off. But 30-year yields, those are up 5 basis points. That's what's leading the sell-off, which brings me to a point I raised earlier this week. I got excited with a VAR shock. And look, I'm still focused on this idea because UK 30-year yields, Anna, you pointed this out, the moves have been remarkable. Before August, the average implied daily move was 8 basis points. We've been moving triple that over the past week. We have gained 200 basis points over the past 20 days. This is AA government paper. It is something that's usually safe, something used as collateral. When you get this much volatility, you get things like margin calls that ripple into the U.S. Treasury market.
Yeah, and what does that do to risk management frameworks? Totally. Danny, thank you very much. Bloomberg's Danny Berger with the latest on those moves in the markets. In related news, U.S. Treasury Secretary Janet Yellen says markets are functioning well despite all of these ructions. Meanwhile, White House officials reportedly are preparing for the potential departure of Yellen after midterm elections. According to Axios, no decision on Yellen has been made yet. Kailey?
Well, Anna, we also want to mention a few of those corporate stories. One we've already taken note of is Apple. Bloomberg has learned it is backing off plans to increase production of its new iPhones this year. The company had expected a surge in demand, but that hasn't happened. Apple will aim to produce 90 million handsets in the second half of this year, which is roughly the same level as last year. Apple shares right now down about 3.6% in pre-market trading. Then another stock we're watching, and this one is a more positive story, Biogen. It is soaring about 46% in pre-market trading after Eisai and Biogen said their Alzheimer's drug slows the disease based on results from a final phase trial. It is a major milestone for researchers who've been working for decades to find a treatment to blunt the most common type of dementia. The companies will apply for a full U.S. approval by the end of March 2023, Matt.
Yeah, that is a very optimistic report, both for the drug makers and for, I guess, society at large. Let's get to one of the big bank CEOs that everyone pays attention to. Deutsche Bank CEO Christian Sewing told Bloomberg that market volatility will continue for the next year, but the German lender is well positioned. He spoke earlier in an exclusive interview.
the volatility will go on, will continue, will stay with us. If you look at the inflation numbers in Europe, if you look at the interest rates going up, I can't see actually that the volatility goes away over the next 12 months.
Sonali Basak, our global finance correspondent, joins us now for more. So volatility, as Kailey pointed out on our call earlier, can be good, can be bad, right?
Yeah, and you have Danny Berger talking about margin calls before I've even started drinking my coffee this morning. So, you know, if you look at the MOVE index, this is across equities and bonds. The MOVE index is marching steadily higher, very close, alarmingly close to its 5-year high. And now you also have Christian Selling saying that volatility could last another 12 months. The VIX is roaring at about 34 today. And so what does that mean? Does it move from productive volatility to gapping volatility, stifling volatility? I'll take a note from Jeffrey Gundlach of DoubleLine, who says that this move in yields is relentless. Remember, a day ago he was saying that the bond market is cheap and he's a buyer recently. And so these sharp moves in the market, as well as not knowing the place to get in, is clearly a challenge for a lot of investors. One really famous short seller online was talking about how he is losing money both on his shorts and his longs. So if you multiply that across the industry, you start to have a bigger problem ahead with a lot less dry powder on the buy side.
Yeah, and of course we're going to get some more insight into just exactly how these banks are faring not too long from now. JPMorgan kicks off earnings 2 weeks from Friday, so that's coming up quickly. Also, these big banks are dealing with a little bit of regulatory issues around WhatsApp. We knew fines were coming, right? $2 billion is the number we finally understand. What is the broader significance, though, of these fines for using not approved communication platforms?
One of the lawmakers last week in Congress had mentioned that Gary Gensler is moving at a breakneck speed. And what you really see is an SEC chair who has been known to rule by enforcement as well. And this is another example of that. That's everything from SPACs to crypto and the banks and the way that they keep records. If you look at really what was said here, a lot of detail. While names were not named within the banks, managing directors, people who were in charge of compliance, were all seen to be faulted with communicating outside of the appropriate channels. So I guess if there's any good news to be had here, it's that there are more jobs created in compliance now on Wall Street. So, which has been the trend here, but certainly something all the banks said that they would do in the wake of this fine and this matter.
Finding the silver lining. Sonali, thank you very much. Bloomberg's Sonali Basak with the latest on the financial services sector. Well, let's go from that to what's happening in Florida right now. Hurricane Ian is now a Category 4 storm, according to a statement from the U.S. National Hurricane Center. The storm is poised to become one of the costliest in U.S. history. It's prompted mass evacuations, school shutdowns, and thousands of flight cancellations across Florida. We're joined now by Bloomberg's Will Wade, who is in Tampa in Florida for us. And Ian has now become a Category 4 hurricane then. What can you tell us?
Yeah, that's definitely the big news. The 5 a.m. update upped the wind speeds to about 140 miles per hour. As of just 2 a.m., it was 120 miles per hour. So that rapid intensification is one of the things we're seeing with hurricanes these days because of climate change. It's definitely going to be a big one. When I drove into Tampa last night, there was definitely a sense from the people that live here that, well, we've been through hurricanes before, but this one feels like it's going to be a pretty significant hit. It's not raining that hard.
Oh, seems it's raining hard enough to cut his line, though.
Yeah, Will, we hope you're safe there in Tampa. I'm just looking, Matt, on the Bloomberg terminal, a great function and functionality. We have Map Cyclone Go. Anna will show you the track of the hurricane. Of course, Ian is not even the only active cyclone you can track on the Bloomberg terminal right now, but clearly it has one with the potential to be extraordinarily damaging. Estimates range up to $45 billion US.
Absolutely. So the focus will be, of course, on any potential loss of life. When it comes to the financials, there is, of course, a read into the Treasuries market here, because insurance companies, if they have to sell Treasury holdings to fund insurance claims, then that's something we need to watch. Also keeping an eye on this as part of the agriculture story, of course, as well, with the orange growing area, fertilizer manufacturer, all happening within this zone. So a lot of ways that this could impact the market. We will check on Will and hope that he's okay. Coming up on this program, though, we'll be hearing from the Austrian Central Bank Governor, Robert Holzmann. If even he says 100 basis points is too much in October, where does that leave the ECB next month? That conversation shortly. Maria Weitmaner joins us, senior multi-asset strategist at State Street. We'll ask about corporate debt and whether that has any warning signs to come for the equity space. We'll also be having a conversation with Poppy Gustafsson, the CEO of cybersecurity company listed here in London, Darktrace. That's shortly. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. In Russia, the Kremlin has declared victory in a series of UN-condemned referendums in Ukraine. Voters in 4 regions occupied by Russian troops have voted to become part of Russia. Moscow ordered the votes after its forces suffered their worst defeats to Ukraine's military since the start of the war. It was a stinging rebuke of the UK's new unfunded tax cuts. The International Monetary Fund called the cuts excessive and in need of revision. That adds to the criticisms of a plan that has sent the pound to a record low. The IMF says Chancellor Kwasi Kwarteng should have used a plan scheduled for release in November to reevaluate the tax measures. And Elon Musk has asked a federal appeals court to throw out his so-called Twitter sitter deal. That's the 2018 agreement with the SEC that requires a Tesla lawyer to screen all of his company-related tweets. In a court filing, Musk lawyers call the government-imposed muzzle on Musk's speech. Meanwhile, inflation in the UK shops set a record this month. The British Retail Consortium said that shop price inflation accelerated to 5.7% in September. The group says that retailers are battling the weak pound, rising energy bills and commodity prices, and a tight labor market. And we just talk about that kind of inflation here in the UK, Anna. Fiscal policy, in theory, could just add layers onto that.
Yeah, absolutely. That has been the fear, hasn't it? In the run-up to that speech we got last Friday from Kwasi Kwarteng, what was billed as a mini budget, but turned out to be quite a maxi one, quite an impactful one. Of course, as we know, taking 30-year gilt yields now from 3.1% to over 5% in the space of less than a month.
Clear, right?
When we first got that talk of the big support package that was coming for households and businesses, there was a sense that that was needed, but then the Chancellor went further than that, didn't he, and delivered tax cuts that were then not given any clear funding source, and so as a result, a lot of people worrying about inflation and worrying about debt levels.
You know, I suppose they're stuck between a rock and a hard place, right? Because they need to somehow help out households who can't possibly afford energy bills going up any higher, but obviously, if you cap energy bills that way, it's going to cause households to spend any extra money they have somewhere else. So it's going to drive up inflation, and that's the kind of thing you would expect someone like Kwasi Kwarteng to already know.
Yeah, and Kailey, a lot of the focus was on the things that didn't come along with the statements, of course. Yeah. So we didn't get the usual forecasts that we would get from the OBR, something we've talked about before, the Office of Budget Responsibility. And so now we're listening for more commentary about debt sustainability, of course, from the Treasury. Let us focus not on the UK, though. Let us focus on the Eurozone economy, and let's get to Brussels. Joining us now, Bloomberg's Maria Tadeo with Robert Holzmann, the Austrian Central Bank Governor and ECB Governing Council member, for an exclusive conversation. Maria.
Yes, Anna, good morning. And we are now joined by Robert Holzmann, of course, the head of the Austrian Central Bank. We're talking about the beautiful sights of Vienna, but here you're talking business in Brussels today. Of course, Christine Lagarde has been very clear rate hikes will continue. Inflation, it's all over the place in Europe, perhaps approaching 10%. When you look at the October meeting, the question is simple. Is it 50 basis points or will it be 75 basis points?
I think the market said 75. I think it's a quite good guesser. I think for most of us, all of us, 50 may be the minimum. We wouldn't go beyond her. Some were asked, could it be 100? It could, but I don't see the necessity now to go as fast. So I think 75 would be a good guess.
So 50 is a minimum, 100 too much. Even for perhaps a hawkish side of the central bank, essentially 75, that's what you're saying. That's where it's going.
Yeah, at the moment, I don't see a need to change the message. I mean, what we have done and what Lagarde said now, we plan for the next several rounds increases there, and we have to increase unless we start to be over the neutral rate, which is still some way away.
And when do you see it, though?
Well, this is a big discussion internally, Since you cannot observe it has to be estimated. And each of us has different estimates, also because within the Euro-land, countries have different neutral rates. We don't have any unique rates there. And it also depends whether you take the lending rate or the borrowing rate, which you take as the base point. So I think, when we above 250, then, we can be sure that we are over the neutral rate, because we have a lower neutral rate than the US. But the neutral rate may be not negative, but slightly positive.
And can it come, or could it come around Christmas as a Christmas gift, perhaps to some?
Well, Christmas starts in December, goes into next year, so everything is possible.
And and what about the conversation around QT? Because it's already in the market, it's already out there. In your view, when should we have this discussion? And when we talk about QT, first of all, it's not just the timing, but what does it imply? Is it actual policy? Is it just a signal? It's getting the conversation started. What's QT for you?
Well, I think you mentioned the points. I think QT must be part of our normalization. This we all know, they all agree there. The question then is when to start it and in what way to start. Is it something which is only not renewing the purchases, which we currently have, or is it something what England does, which is actually also selling? I think the discussion internally we have not finished yet. We will have a discourse over the next couple of months. What's to do? It will be certainly something which to expect sometimes next year, not the beginning. Sometimes it will happen there. And here, I think also, if you recall, at the moment we have PEPR, the end of QT for the end of the year. So it's not immediate. Of course, we can always change that. And for ABB, we have not an end yet signal there. So I think it's important to make the market understand. But for me, very importantly, is we have at least 4 countries that have QT. US, UK, Australia, and Canada. And I ask the ECB to do a study how QT has impacted their financial market. I think this would be an important message and guideline for us to understand.
Your discussion. And if I listen to everything that you said, 75 basis points seems to be the right way. There needs to be already a debate around QT, the impact that it has and how it would work. By this time next year, the market's already priced in, the ECB will be in restrictive territory. That's essentially where we're heading. Is that something that you would share? That same overview?
To say a lot of water will come down the Danube, the Rhine, and we will have a number of new reality there. So I would be cautious there. We have seen now the attacks quite likely on the gas pipe. I think we live in a very uncertain environment, but what we can say is this all will be taken into account when we talk about the QT, and this all needs to be processed.
And just as a final question, there is a debate for central banks that you have to hike, you have to show you're serious about inflation, but that could send your economy into a recession. There's a question as to how big, for how long, how shallow. But I wonder, is there anything that could happen from now until December that could derail the plan that you laid out? At a point in which you go, we have to stop the hikes. Something's happened. Is there anything that you view as a risk that could stop that roadmap that you laid out for me?
I hope I don't see it, given the geopolitical part of it. So I don't see it from now to December. It's not on my radar scale, but what we all know, the tail risk is there. The tail risk can happen, and I would see it not at the economic side, but at the geopolitical side. But at the economic side, I don't see a tail risk currently in order to derail what we want to do here between here and the end of the year.
And of course, that risk has a name, and it's Vladimir Putin. Well, thank you so much for your time, Governor. Always good to see you, and hopefully next time in Vienna, because it's a beautiful place.
Thanks, and pleasure seeing you.
Thank you very much. Well, that was, of course, Robert Holzmann, the head of the Austrian Central Bank, joining us here on Bloomberg TV. Kailey?
All right, Maria, thank you so much for that great interview. Bloomberg's Maria Tadeo with the Austrian Central Bank governor advocating for 75 basis point move from the ECB. Coming up, we're going to talk about how monetary policy is influencing the equity markets. Maria Vetmana, senior multi-asset strategist at State Street, joins us next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The dollar soars to another record. President Biden's top economic advisor says he doesn't see another Plaza Accord-style agreement to weaken the greenback. Apple's putting plans to boost production of its new iPhones on hold. The expected surge in demand never took place. And Deutsche Bank CEO predicts a deeper recession in Europe over the next year. Christian Saving sits down with Bloomberg TV for an exclusive conversation. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Pretty risk-off throughout much of this morning's European session. Matt, what do you see in U.S. futures?
Yeah, very risk-off here as well. Just 4 hours away from the opening bell, and futures are now down more than 1% on the S&P. Of course, we closed well below 3,700 yesterday. I think 3640 something. So keep in mind that strategists are expecting us to get to 4,300 by year-end 2022. A lot would have to change. Certainly, this would have to change. 1360 on the Bloomberg Dollar Index, another all-time high for the broad measure, and you can see that in the pain felt in the pound as well as the euro and the yen. Those central banks are going to have to react, or at least in terms of Japan, the finance ministry may have to react, possibly by selling more treasuries. That could be one way they defend the yen. And as a result, we see, or if that's happening, that's adding to the upward pressure on yields here, right? As investors sell off the 10-year, we get yesterday over 4%. Now we're at 399.86. So we're basically at 4% now, and that's the first time that we've seen it since 2010 at that level. I remind you, even though it seems like 2010 was a couple of years ago, it was actually 12 years ago. Bitcoin right now down more than 2%, acting as once again a very correlated asset to other risk assets, and it down now below 19,000 at 18,652. Kailey?
Matt, I just want to fact check you because I think it's even further back than that. October 2008. 14 years is the last time the 10-year was this high. It's just absolutely astounding any way that you look at it. And of course, those higher rates weigh on big tech stocks, but they have some other idiosyncratic things going on today as well, specifically for Apple after a Bloomberg scoop overnight that it is abandoning its plans to increase iPhone production of the new iPhone 14. It initially thought demand was going to materialize, and it did not. So they're keeping it at 90 million units, which is the same as last year, and in line with their initial forecast. They're just not ramping up production any further than that. So as a result, Apple down about 3.8% in pre-market trading, and you're seeing a drag on Apple suppliers as well, the likes of Qualcomm down the better part of 3%. It's a more positive story, though, for Biogen, releasing trial figures from its Alzheimer's drug trial with its partner Eisai. Positive results. That is lifting the stock about 42% right now in pre-market trading, and there is a read-through to Eli Lilly, which is developing a similar Alzheimer's drug. So the positive data out of one trial giving a lift to that stock, Anna. Eli Lilly up about 8% for its part in pre-market trading.
Kailey, we see a little bit of read across from that Apple story into the European equity markets, but more broadly, this is the negativity across Europe. Yes, partly sentiment driven around the Apple story, but very much driven by higher yield environment, higher dollar, all of that weighing on sentiment, so down by 1.7%. And even the banking sector, which would benefit, of course, from higher interest rates to some degree, that is selling off because of concerns about global growth, European growth. The euro down by at 0.95, so that's where we are, well below parity then on the euro, down another 0.4%. A 20-year low for the euro now, and we're talking about concerns around funding for European businesses. We've seen a bit of a push higher, the highest level since 2012, in terms of the cost of insuring against default, the ITREX index, that is, for European high-grade corporates. The UK 30-year yield in focus. So we talked a lot about the short end of curves and how that's been driving things over recent months, but this week seems to be very focused, or today certainly very focused on the 30-year. So the 30-year now over 5% in the UK. It started September down with a 3 handle. 3.1% is where we started the month. And so substantial moves coming through, the highest rate of borrowing for the UK government at this duration since 1998. And ST Micro, that is the read across I was talking about when it comes to the Apple story. So if Apple's selling fewer iPhones, then fewer chips perhaps needed globally. Matt?
All right, just want to quickly break some news here on Cineplex, the, I think, Canadian movie theater, in any case North American, is looking to revive merger talks with Cineworld's Regal Theaters. So according to Dow Jones, at least, Cineplex looks to get together with Cineworld's Regal. Obviously, we have seen real declines in theater attendance, even taking out the almost 2 years of COVID. Compared to 2019 levels, we're still well down, even with Top Gun 2, which hopefully we've all seen by now. Joining us now is Maria Feitmana, Senior Multi-Asset Strategist at State Street Global Markets. Maria, the volatility that we're seeing here, the almost unprecedented rise in rates, and the incredible strength of the U.S. dollar, is that going to lead to further drops for risk assets throughout the year?
Yeah, no, I'm afraid so. I think pretty much everywhere we look, we see more signs of very, very challenging backdrop for risk assets. Absolutely.
Challenging for risk assets. Maria, good to see you. So is there anything that any straws you're clutching at? Because, you know, we've spoken to you many times, Maria, over the years, and you were positive on stocks until, well, you tell me, till quite recently, I suppose. Anything that you're still looking at that could turn you more positive?
Yeah, no, I mean, it's absolutely right. I've been very, very positive. The big change for me, kind of 180-degree change to me, for me happened around March time, when Fed has told us that we have two mandates, price stability and economic growth. We're going to focus on price stability. Economic growth will have to suffer. And that was a kind of deciding moment. And I mean, they're really, really focusing on price stability. They told us many, many times that they need to bring inflation down. They're going to raise rates. There were various periods of market not listening to it and kind of saying, no, we have Fed put. We remember that times. No, Fed is really focused on price stability. It means higher rate. It means lower multiple for stocks until they break economy, and then earnings will go down. So for me, it's very difficult to see that change in direction. So all the things that Matt was talking about, dollar, interest rates, I'm afraid there are more negative news.
And you set out a sort of chain of causality there, a chain of the way this flows through the economy. Where does corporate debt fit into all of that? Because I know equity is your focus, but I wonder if this is linked. We've seen credit risks for the safest European bonds rising to the highest since 2012. The ITRAX index measuring that. UK corporate refinancing costs at record highs after this most recent market rout. Where do these debt pressures worry you most?
I mean, it's interesting. So, I mean, you can have you say I come from equity, so I'll give you read across from equities is that we're seeing compression in multiples. We're seeing risk going up, spread rising, but we haven't seen a lot of earnings collapses. We haven't seen a lot of defaults. So that's next. So to me, that's really worrying bit is that we're not even halfway through. So that's a big worry in terms of a downside for the market is that we see risks now, but we'll need time for them to realize before we can move on to the next stage.
All right, Maria, so your bullishness is maybe dead or at least in hibernation for now. Is Tina dead too? Is there now real alternatives?
Yeah, no, that's a really good point. And I mean, I've seen new acronyms coming up. There is real alternatives, there is TARA, there is Tiara. So I think market needs to settle on something. But yes, I mean, bonds are yielding more, cash is becoming far more attractive. So yeah, I mean, somebody asked me, which stocks do you want to buy? I said none. So I think that probably gives you an answer.
Well, that's quite telling coming from you. So if you don't want to buy stocks, what do you buy? What is the best hedge here if you want to play defense?
I mean, as we said, cash is interesting, but we are focusing on kind of real relative value trade. So where within, say, equities, you can see some opportunities, and that's stable cash flows, that's dividends. I mean, we're still fans of energy relative to maybe some industrials. So yeah, relative place is probably the best way to defend your portfolio at the moment.
What do you look for to see that we've oversold? Clearly, you know, the pendulum always tends to swing too far in either direction. A lot of people are saying, for example, bonds are a buy right now. Jeff Gundlach, Sonali Baskett was telling us earlier, has already started. Where do you see the signs?
No, not yet. I mean, the thing that I'm looking at is labor market, and I think that to me would be the first indication that we created enough economic slowdown, we disrupted enough demand for people will spend less, and then inflation start to go down. As long as labor market is strong, I think Fed's job is not done, and they need to push more. That will create more negative momentum.
Maria, I just want to dip into FX markets for a moment because we've just got some lines coming through from China. China. China's PBOC asking banks to protect the authority of the yuan's fixing. We've seen the PBOC trying to make it more expensive for traders to bet against the value of the Chinese currency in recent days and weeks. How concerned are you about the strength of the dollar and the ripple effects that is having on the global economy? Is this something that, quote unquote, breaks, and what does it break?
Oh, that's I mean, I am concerned, and it will break global economy at some point, but I think it's too dangerous to bet against it. I mean, we see lots of intervention, but to me, dollar strength is another manifestation of this kind of regime change that Fed is set on to remove liquidity from the market, is set off to slow the economy, and when that's happening, people go to safest of safe havens, which is dollar. So yes, it's setting up for a break, but you kind of can't fight it. You can't fight the Fed.
Okay, Maria, thank you very much. Thanks for joining us today. Maria Weitmaner of State Street. And the breaking news still coming thick and fast. I mentioned the PBOC. We're also getting lines coming through from the Kremlin spokesman, Peskov, saying that claims that Russia sabotaged Nord Stream are, quote unquote, stupid. He's also saying that Putin will meet with the heads of the Russian-occupied regions. Nord Stream situation requires dialogue and cooperation, according to the Kremlin. We've heard, of course, the Europeans have said that they believe this is sabotage, that those two pipelines were sabotaged, as is the US belief as well. Coming up on this programme, back to the banking sector, Deutsche Bank says it is well positioned for volatility. There's been a lot of that. Part of our exclusive interview with the CEO next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with U.S. Special Presidential Envoy for Climate, John Kerry. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. The Bloomberg Technology Summit, though, kicks off today in London, bringing together Europe's business leaders, policymakers and entrepreneurs to discuss things like AI, crypto, cybersecurity. Bloomberg's Tom McKenzie has been there this morning and joins us now from the summit with the CEO of Darktrace, London-listed, leading autonomous cybersecurity and AI business. And he's with the CEO of Darktrace, Poppy Gustafsson. Good to see you, Tom.
Hi, Anna. Yeah, as you say, one of the leading cybersecurity companies, Darktrace, the CEO, Poppy Gustafsson, very happily to say, joining us here in the lobby, as you hear all the delegates around us during this break. But Poppy, thank you for your time. Look, one of the key stories today is what's been happening with potential sabotage around Nord Stream. We're still getting to the bottom of what the details are, but it brings to mind some of the deals that you've been doing and the customers you've been bringing on around critical infrastructure, and the resilience or not of our infrastructure, particularly our energy infrastructure. What are the needs, the cybersecurity needs of companies that operate and maintain and build out that infrastructure?
I mean, critical infrastructure is an area that absolutely has to be right at the cutting edge of adopting sort of cyber principles, because they are so many businesses rely on their products, whether that's energy or other sort of supplies. And this isn't something that new that's necessarily come out today. Even with things like sort of Russia and Ukraine early in the year, we have seen significant demand for our products from the critical national infrastructure sector purely for that reason, because they are at heightened risk and there is such a dependence on their supply to so many other businesses.
Which particular areas? Is it utility companies? Is it energy companies? And what are the specific demands that they need, the specific challenges they need addressed?
It's all of the above. Just think about how many businesses depend on the services that they supply. So utilities and energy, we have seen heightened demand both in terms of Europe and in US. And that's because they're an easy target. If you are operating a business that typically can be reliant on very old legacy systems that have been around for decades, they're not necessarily at the cutting edge of capability. But also, if you are looking to enact your cyber gains and use that for nefarious reasons, they're a very high-profile target where the consequences can be felt very, very highly, and therefore it makes a sort of ideal victim, if you like, for cyber attackers.
You monitor this, obviously, on a daily, hourly basis. Are you seeing a tick-up of attacks emanating from Russia?
We're not in the business of attribution necessarily, so we're not necessarily saying this is coming from one nation or the other. But since the invasion of Ukraine, we have seen an uptick in attacks across the critical infrastructure sectors, particularly in Europe and the US.
In this environment of higher interest rates, slower growth, recession concerns, are you seeing reluctance from clients and customers? Are you starting to see that ebb away?
I've answered this question in the past. I think, to be honest, we are, as a business, we're still quite a poor indicator of demand more broadly because we are still very much supply constrained rather than demand constrained. So our business grows the quicker that I bring people in. So we're not necessarily a good proxy about what is happening in the market more broadly. But from our perspective, we're still seeing very strong demand for our products.
Are acquisition costs, are they inevitably going to be moving higher in this environment?
I think you're seeing inflating costs sort of all over, predominantly in terms of, you see that in terms of employee costs and things like that.
Okay. A few months ago, Thoma Bravo you were in conversations with them, of course, about a potential takeover. It didn't come to pass. Can you give us some detail as to why ultimately they walked away?
I mean, I had to be sort of fair. As you can understand, I'm fairly limited by what I can and can't say. But what I will say is we've loved being a public company. I mean, there's a whole ton of ideas.
Was it a question of pricing, or did they find something that they didn't like?
I would say, no, these conversations leaked at the very earliest stage of engagement with Thoma Bravo. That unfortunately became public, and in September we said that those conversations had ended. We have a legal obligation to explore any such offers, but if I was sat where Thoma Bravo is, I'd be looking across at the UK thinking, it's a very cheap area to be able to come and potentially do some takeovers now.
Does the collapse of the pound make you a more attractive target, and are you in conversations with anyone else?
I would speculate that if I was on the US side looking over here at the UK, I would say, yeah, the UK does look cheap, but from my perspective and from my business, we're just really prioritising or exploring all of the opportunities that we see ahead of us. And we've got a whole bunch of ideas, a whole bunch of innovation. We had a new product launch over the summer, and we're just really excited to get back to business as usual.
What are you doing in terms of headcount and cost cutting? Are you going to have to trim headcount?
Grow. We are in a growing market. We have a big business opportunity ahead of us. My priority is bringing many people in as we can.
Okay, where are you prioritising the R&D spend at this point, Poppy?
R&D spend, we have got a world-class R&D team in Cambridge. And I think one of the things that we do really well is we've got this brilliant eclectic mix of multidisciplinary people that we've got, theoretical linguists in there and microbiologists as well as your computer scientists. And my priority is bringing in more and more of those brilliantly capable people and using their skills to solve the problem of cybersecurity.
Poppy Gustafsson, CEO of Darktrace. Before we let you go, one more. I've just been told I get another question, but I'm conscious of the fact that you are shouting elegantly above the din here. How concerned are you? We talked about the pound, but more broadly, how concerned are you about UK PLC? At this point, this time, the government's plans, are you concerned that we could be heading into a potential crisis here?
I think UK PLC, the UK is known for some world-class innovation, and we've got to be more confident in backing that innovation and standing up on our own 2 feet and proudly celebrating everything that we have achieved. I think when it comes to things like exports, there's an opportunity there to be able to export more of our products across the world. But from my perspective, I would love to see the UK really stand head and shoulders above the best and show what we are capable of in terms of technology.
Okay. Gustafsson, CEO of Darktrace, talking about the value that you can now get in the UK on the back of the falling pound, and painting a bullish picture of some of the skills and qualities and tech ingenuity we have here in the UK, despite all the broader macro woes. Guys, back to you.
Yeah, that was positively uplifting. T-Mac, thank you very much. Excellent interview. Thanks very much as well to Darktrace CEO Poppy Gustafsson. Now, let's get to an exclusive interview with Deutsche Bank CEO Christian Sewing. He expects market volatility to continue for the next year, but the German lender is well positioned for that. He spoke exclusively with Bloomberg's Haslinde Amin.
This is the decade of volatility because a lot of things which happened then obviously also with the awful war in the Ukraine show to us that volatility will take over, and that means you need a superb risk management. And fortunately for Deutsche Bank, we have transformed this bank over the last 4 years quite significantly. We always said core to our business is our own risk management, the positions for the clients. And that's exactly what we are doing these days. We want to be close to our clients in each and every market here in Asia, but also in Europe and in the US. and convince the clients with our risk management capabilities. I think that is really key, because in these days, if you don't have a proper risk management, you can't be close to your clients.
How much exposure do you have to UK assets? They have imploded. We have the pound at a 37-year low. We have yields in the UK surging, 10-year yield at 5%, 40, 50-year bonds are trading at 25 cents. How is that impacting you? What kind of losses are you looking at, possibly?
Well, fortunately, we have a very diversified book. This is the advantage of being a global bank. This is the advantage of having a bank with 4 proper business lines, so that you're not dependent too much on one business line. And again, we entered this kind of period with a clear view that volatility takes over, that these kind of moves are not unrealistic, that this could happen, and this is the way we positioned ourselves. And in this regard, I'm actually quite comfortable and also confident with the positions we have.
Is the UK experiencing a currency crisis right now? And if it isn't, are we looking at one in the coming weeks?
Well, obviously, we are seeing almost dramatic moves. But I wouldn't talk about a currency crisis.
Not yet?
I clearly think, the UK has seen over the last, if I look at these kind of countries like the UK, I'm looking back for the last 50, 70 years. And they have maneuvered through various crises. So I'm confident that the UK will come through this. I cannot tell you actually what the today's rates move are, and volatility, as I said, stays. But I can also see that over time the pound is coming back.
An exclusive interview with the Deutsche Bank CEO Christian Sewing there. Joining us now to take stock of where we are on markets, Simon White, Bloomberg macro strategist. Simon, everything seems to come back to treasuries. Everything seems to come back to where we are on interest rates right now. I've been looking at the corporate credit story. Credit risk really rising in Europe, as measured on the chart I'm looking at of the market iTraxx Europe index. Not quite rising to the same degree in US corporate spreads, but clearly something is stirring within the corporate credit space. Where has this latest leg up in Treasury yields come from? More Fed hawkish speak, it seems.
Yeah, I mean, there's been a kind of reevaluation. I think people thought the mistake that the Fed was going to pivot too early is now it's going to pivot too late. So we've seen this rise in rates at the front of the curve. But I think really interestingly, what that means is that people believe that the dollar is going to be bid for much longer. And if you're an energy importer, that means that your energy bill is going to keep expensive. It's going to be harder for you to get dollars. So on net, you're seeing these countries are basically having to shed debt, shed treasuries. So that's causing the longer end yields to rise as well. So you're seeing this sort of move up in yields, like across the curve, but it's for different reasons.
So we had the Japanese finance ministry intervene in markets for the first time since 1998 to protect the yen. There was a report that Kwasi Kwarteng is going to ask bankers not to bet against the pound. And now we see a headline, China's PBOC asks banks to protect authority of the yuan fixing. I mean, if you have to ask, it's too late, right, Simon? What's going on here?
Yeah, exactly. I mean, for a start, I think trying to tell traders not to short something is probably a red rag to a bull. But clearly the big thing here is the US. I think everything else to some extent is a sideshow. They're determined, so they've said, to get inflation down. We'll see their mettle tested when the unemployment rate starts to rise. But for now, that's the strong message that they're sending. They're going to keep raising rates, keep tightening policy until they see core inflation coming down, and that causes a lot of ructions across the world, from currencies to yields to corporate debt.
Well, and that's what we heard from Treasury Secretary Janet Yellen yesterday. She essentially said financial conditions tightening is what we should expect. She also said that market conditions right now do not look disorderly. Really?
Yeah, I mean, I think you've got to be careful. I think there is definitely liquidity issues within the Treasury market. I think that's exacerbating some of the moves. You have $7.5 trillion of treasuries owned by energy importers, so there's a lot of pressure on selling pressure there. And as I say, if you look at measures of liquidity, bid-offer spreads and things like that, there's clearly been a deterioration in liquidity. So I think that's exacerbating the moves, but I don't think we're quite in disorderly markets yet. Certainly nothing like the financial crisis.
Yeah, our colleague Mark Cudmore earlier on telling me, you know, it's not panic. It doesn't look like panic yet. And maybe that's what she was referring to. Simon, thanks so much for your time. Bloomberg's Simon White joining us then on the latest on the markets. And just to recap where we've got to on the UK rate story, as we've been tracking that very closely this week, UK short bonds are rallying. 2-year yields dropping 10 basis points to 4.55%. They've travelled a long way higher, though, in the meantime. That is it for Early Edition. More surveillance is ahead. Tom, John, Lisa, they will have all of the latest market moves, the selling we're seeing in European stocks, US futures pointing lower. This is Bloomberg.